Welcome traders. Today, we're diving into the dynamic forces driving both Bitcoin and gold higher, and what this means for your trading strategy. On June 12, 2025, we're witnessing a significant surge in both Bitcoin and gold prices, triggered by the latest U.S. Consumer Price Index, or CPI, data release. The inflation reading came in notably lower than Wall Street's expectations, signaling that price pressures are cooling off at a faster pace than most analysts had forecasted. This surprise has sent ripples through global markets. As a result, traders are now recalibrating their outlook for the Federal Reserve. The consensus is shifting toward the possibility of interest rate cuts happening sooner than previously anticipated, which is a major catalyst for both markets. A weaker US dollar, which often follows expectations of lower rates, typically boosts demand for dollar-priced assets like gold. This makes gold more attractive to international investors seeking stability. Gold, as a non-yielding asset, shines brightest when interest rates fall. Its opportunity cost drops, and investors seeking a safe haven often increase their allocations to gold during such periods of uncertainty. Bitcoin is rallying for two main reasons. First, it benefits from lower rates as a risk asset, attracting speculative capital looking for higher returns. And second, it's increasingly viewed as digital gold, a hedge against currency debasement and inflation, especially as traditional fiat currencies face pressure. The prospect of easier monetary policy encourages capital to flow into assets with higher growth potential, including cryptocurrencies and precious metals. Investors are seeking both growth and protection. Both assets are reacting to the same macro catalyst, but with slightly different narratives. Gold as a traditional store of value and inflation hedge, Bitcoin as both a risk-on asset and an alternative store of value, appealing to those looking for diversification beyond the legacy financial system. Today's moves are a direct response to the shifting outlook for U.S. monetary policy, as well as the global search for both yield and safety in an uncertain environment. Next, let's break down the key technical levels, price action, and trading strategies for both Bitcoin and gold, so you can navigate these volatile markets with confidence. On the Bitcoin chart, price was consolidating for several sessions between the $88,500 support and the $92,000 resistance before today's breakout attempt. This tight range reflected a period of indecision as traders waited for a catalyst to drive the next major move. The longer price stays compressed within a range, the more explosive the eventual breakout can be, as both buyers and sellers build up positions. The release of the latest CPI news acted as a powerful catalyst, injecting fresh volatility and pushing Bitcoin to challenge the $92,000 ceiling, a level that's capped rallies for several weeks. This resistance has proven stubborn, with multiple failed attempts to break above it, making today's move especially significant for market sentiment. A strong daily close above $92,000, especially if accompanied by high trading volume, would confirm a bullish breakout and open the door to the psychological $100,000 mark. This level is not just a round number, it's a major milestone that could attract new buyers and fuel further momentum, as traders and institutions alike watch for confirmation. On the flip side, if the rally fails and price drops below $88,500, it signals fading momentum and a likely return to the previous trading range. Such a move could trigger stop losses and shake out weak hands, leading to increased volatility and a possible retest of even lower support levels. The 50-day moving average is trending up, reinforcing the bullish bias as long as price stays above it. This moving average often acts as dynamic support in uptrends, and traders will be watching closely for any sustained closes below it as a potential warning sign. The RSI is nearing overbought territory, but in strong trends this can persist for extended periods, so use it as confirmation, not a standalone signal. Overbought readings can sometimes signal strength rather than imminent reversal, especially during powerful breakouts. In summary, watch for a decisive daily close above $92,000 for confirmation of a breakout. This level remains the key battleground between bulls and bears. A confirmed breakout could trigger a new wave of buying, as traders rush to capitalize on the momentum and institutions potentially step in to add exposure. If the breakout is rejected, expect a retest of lower support and watch for how price reacts at those levels. This will offer clues about the underlying strength or weakness in the market. Volume is key. Look for a surge to validate any breakout. High volume confirms conviction behind the move, while weak volume can signal a potential fakeout. Next, let's see how gold's chart compares and whether it's showing similar breakout potential or diverging from Bitcoin's price action. Gold is also breaking out, fueled by the weaker dollar and shifting rate expectations. After trading quietly near $2,350, the CPI news sparked a decisive rally above this key level. The next resistance is $2,400, a major psychological and technical barrier. A clean break and hold above $2,400 could set up a run at all-time highs. If gold pulls back, $2,350 should now act as support. Bulls want to see buyers defend this level. The daily chart shows higher lows and price above key moving averages, confirming the uptrend. Momentum indicators like MACD and RSI are bullish, but not yet overextended. The combination of a fundamental catalyst, breakout, and strong technicals makes this a high-conviction setup for bulls. Now, let's turn these insights into actionable trade ideas. Here are 2 actionable trade setups to consider. Keep in mind, these are shared for educational purposes only, and not financial advice. Always do your own research and consult with a professional before making any trading decisions. For Bitcoin, a potential strategy is to wait for a confirmed daily close above the $92,000 resistance level. Once that happens, you could look to enter a position at $92,200, set a stop loss just below $89,800 to manage downside risk, and aim for a target around $98,500. This approach is designed to protect against false breakouts, which are common in volatile markets, and it offers a strong risk-to-reward ratio if executed with discipline. For gold, consider a buy-the-dip strategy if the price pulls back to the $2,350 support zone, which has acted as a key level in recent trading sessions. You might enter around $2,355, place a stop at $2,335 to limit potential losses, and set your target at $2,395 for a favorable reward. Before entering, wait for confirmation with a bullish candlestick pattern or a clear sign of buying momentum to increase the probability of success. Both setups clearly define risk and are based on key technical levels, helping you avoid emotional decisions and stick to your plan. Remember, don't chase moves, let the market come to you. Patience is often the difference between a good trade and a bad one. Always size your positions according to your personal risk tolerance and never risk more than you can afford to lose on any single trade. These strategies are most effective when combined with disciplined execution, a well-defined trading plan, and strict risk management. In volatile markets, risk can change quickly, so let's review how to manage risk and adapt your strategy as conditions evolve. Stay patient, stick to your plan, and remember that consistency and discipline are key to long-term trading success. Risk management is your shield in volatile markets. Never risk more than you can afford to lose. A common rule: risk only 1 to 2% of your account per trade. Calculate position size by dividing your max risk by the dollar distance between entry and stop loss. This keeps losses manageable and allows you to survive losing streaks. Emotional trading, fear and greed destroys accounts. Stick to your plan, not your feelings. Define your entry, stop, and target before entering any trade. Once in, execute the plan. Don't let price noise shake you out. Accept small losses as part of the process. Don't chase losses or move stops impulsively. Consistent risk management builds discipline and protects your capital. Remember, trading without a plan is gambling. Now let's cover the most common mistakes to avoid in fast-moving markets. Fast markets tempt traders into costly mistakes. Here's what to avoid. Overtrading after big news leads to a string of small losses. Focus on quality, not quantity. FOMO, jumping in without a plan, often ends badly. Always know your entry, stop, and target before trading. Revenge trading after a loss is emotional and usually compounds losses. Accept losses, reset, and wait for the next setup. Chasing price without confirmation is risky. Wait for pullbacks or clear breakouts. Ignoring volume is a mistake. A breakout on low volume is likely to fail. Use volume as a filter to confirm the strength of moves, especially at key levels. Don't let emotions override your strategy. Patience and discipline separate winners from losers. Review your trades and learn from mistakes. Let's wrap up with what to watch for next in Bitcoin and gold. Looking ahead, all eyes are on the Federal Reserve's upcoming statements and the FOMC decision. A dovish Fed could fuel further rallies in both Bitcoin and gold, pushing them through resistance. A hawkish stance could trigger sharp reversals and test key support levels. Watch for volatility around Fed communications. Manage your risk accordingly. Geopolitical tensions can also drive gold higher, regardless of Fed policy. For Bitcoin, regulatory news and institutional adoption remain key long-term drivers. Monitor $92,000 for Bitcoin and $2,400 for gold as critical resistance. $88,500 and $2,350 as support. Stay alert, adapt to new information, and protect your capital. Share your analysis and questions in the comments. Learning together makes us all better traders. Thanks for joining today's analysis. Trade smart, and see you next time.